With the market shifting, there's a good chance a recession is coming. The worst case predictions say that we'll be in a recession by the end of 2022 or the beginning of 2023, and it's not going to be pretty. There's no way of knowing for sure. Still, it is better to be prepared than not, so we're going to show you the best ways to prepare yourself so that even if there is a recession, you'll be safe and sound with your finances. Here are the 4 simple tips that can help you prepare for a recession. All you need to do is follow these simple tips and you're on your way. Number 1. Clear your debts. Whenever an emergency arises, you'll want to cut as many of your monthly costs as you can. Because high interest debt payments are among the priciest ones for your budget, it's especially important now to clear all of your debts. The Federal Reserve is anticipated to raise its primary borrowing benchmark 7 times this year. All other short-term borrowing is influenced by the federal funds rate, which is the interest rate set by the Federal Reserve. Credit card debts tend to have high interest rates. The average annual interest rate for credit cards remain close to 16%. You can incur additional monthly costs of hundreds, if not thousands, if you carry a balance from month to month. By paying off that debt, you can gain vital space in your budget that you can use to increase your emergency savings. You can better prepare financially for other things if you're in a situation where you've reduced those kinds of expensive responsibilities. The more you can set aside for savings and the less debt you have, the more money you'll have on hand in an emergency. According to the New York Household Debt and Credit Poll for the first quarter of 2022, Americans also owe $10.93 trillion in mortgage loans, $1.58 trillion in student loan debt, $1.46 trillion in car loans, and $318 billion on home equity lines of credit. However, it would not be advisable for consumers to focus their attention on repaying loans with comparatively lower interest rates. Focus on those high interest loans. Although there are different guidelines for lending institutions, borrowers can frequently work out a short payment arrangement or submit a request for suspension in the case of an unexpected job loss or health issue. In even more severe cases, government intervention may occur, like during the COVID-19 period when payments from federal debtors were suspended. But we cannot assume this will happen every recession. Number 2, plan your debt payment and savings wisely. Examine your emergency savings. If you don't have much money set up for an unforeseen loss of employment, you may want to think about putting any additional income toward your savings account. This could even mean picking up a second job or a side hustle. Lack of emergency funds is another reason consumers keep racking up credit card debt. You're forced to use credit cards once more to pay for an emergency if you're trying to pay off debt with every dollar you have. People need to manage their loans carefully. Financial experts advise having 6 months' worth of spending on hand in a liquid account that is easy to access as a vital safety net for unanticipated events like job loss or salary reductions. Americans without jobs can frequently resort to unemployment compensation insurance for financial assistance. The amount that each person receives varies by state, but generally speaking, the aid program replaces only 50% of workers' salaries. If legislators do not improve the program, as they did in the period of COVID-19, it may be difficult to put together 6 months' worth of expenses, but just don't overvalue the influence of little donations. You may develop the essential saving habit by consistently contributing to your emergency fund over time. Even better, use automation to set the operation on auto with your contributions. The crucial next step is determining where to keep your money. Online banks sometimes provide rates on savings accounts that are many times higher than the national average. Find the finest account for your needs and way of life by shopping around. A quick reminder before we continue our discussion on this topic, if you've enjoyed this video so far, consider subscribing as we frequently upload such informative and educational videos. Let's continue. Number 3, recession-proof measures. One of the smartest investment options is continuing your education to recession-proof your life. Those who are bachelor's graduates or above have a substantially lower unemployment rate throughout recessions than any of those with only a high school diploma or less. As per the Labor Department, only 2% of employees with bachelor's degrees or above were jobless in March, compared to 4% of high school grads and 5.2% of anyone without a diploma. Finding new chances could also be aided by connecting and sustaining solid relationships with others in your industry. Even better, developing your skills and abilities and obtaining additional training could increase your marketability in your industry. The booming job market of today may also be advantageous for consumers. Employers have been seeking candidates for a near record amount of open positions as unemployment is close to a half-decade low. Companies are raising pay in response to the labor scarcity. According to the Atlanta Fed's wage growth tracker, those who changed jobs were able to get the greatest pay in the year, with their salaries increasing by 5% from a year before, as opposed to 3.8% for those who kept their jobs. At a time when consumers are losing their spending power at the quickest place, having additional money might be an essential strategy to boost your income. You may also put the additional money you make into your savings. Number 4, income streams. Developing your networking opportunities may improve your employment prospects, which may be beneficial in the event that you are laid off by a recession or require additional funds. Additionally, you might consider starting a business today to generate an income stream later on or seek side jobs to diversify your income sources. Although the prospect of a recession might be unsettling, it is a common occurrence in the economy, one that occurred in these 2 decades alone in the years 2020, 2009, and 2001. The best approach to defend yourself and remain on top of the game is to train yourself to recognize the warning signs and to be well prepared. One of the best things about having more than one income stream is that you can easily manage any financial difficulty and even plan for the long term. It doesn't matter if there is a recession or GDP growth in the economy. Putting these sound financial ideas into practice will help you have a better budget and more chances. The best method to raise your savings and be ready for unforeseen events is to keep track of your spending. Make regular adjustments to it, accumulate an emergency fund, and look for ways to enhance your current situation. What measures are you taking to prepare for a possible recession? Share your tips with us in the comment section below. If you learned something new today, like this video and share it with your friends. Make sure you subscribe to our channel and click on that bell icon to keep getting notified of our new videos. Until next time.